Yo, mic check. Let's get it. Good evening, everybody. I don't know if anyone is watching live. If you're with me live today, we are doing another FOMC meeting, a Fed fund rate. I'm just going to share my screen with you guys and quickly share screen number 2. So we're just going to quickly see what they drop. No point in speculating, no point in guessing, right? It's just keep trading simple, master the strategy and trade the data with your supply and demand. Should drop anytime from now. I've got poor network. Right, so the expectation is 50 basis point. The fear is we go 75 basis point or a full point, like 100 basis point, basically. There are multiple scenarios I need us to run through, but let's first see what they did. Let's first see what... Oh! 75, right? So we got right, and this is Powell, by the way. You guys can hear me, right? Please, can I get an audio check before I start talking? Can I get an audio check? Can I get an audio check? Can you guys hear me? Can you guys hear me? Hear me? All right, cool. So it's cooking. It's cooking. Yeah, man. That's exactly kind of like what I thought was going to happen. There we go. Federal Reserve hikes by basis point 75 versus, what was expected, blah, blah, blah. The previous market range changed, right? It was just a basic sentiment across traders, right? But the forecast on Forex Factor remained based on what Powell had said in the last meeting. Fantastic. Thank you, Alvin, which was he's not going to do 0.75. We're going to do 50 basis points. The previous month, 50 basis point in June, 50 basis point in July, and then we see from there. All right, but this was contingent or literally based. I'm sorry, there's no video, by the way. I'm wearing pajamas and down. It's very cold tonight, very, very cold tonight. But yeah, so all this was kind of like, premises on a couple of things. And the main thing was, let's keep inflation down, let's keep jobs contained, right? So let's kind of look at the markets. Let's look at our dollar. Let's look at how our dollar is reacting. And again, this is not going to be the first time this has happened. It happened exactly the same way in March. So that's why I prefer doing these things live now with you guys, because, at some point you're expecting the dollar to rally because, it's just gotten a big interest rate boost, right? But then the dollar strategically always finds itself placed just outside a governing supply, right? So when that happens, you know what's the reverse is true. All right, so most of the time or all the time we want to trade structure. Now on Sunday, and I'm going to talk, if you guys don't mind, I'm going to talk until 8:30, until Powell comes to talk to us. On Sunday, with this is supply here, and if you recall on Sunday, those of you who attended the war rooms, I kept saying, this is just, it's a nice setup, right? There's that arrow effect. But also on the weekly time frame, there are better supplies, right? So you can see all my arrows are marking that better supply up there. And we're looking at things like NZD, USD. There were a lot of USD and NZD, or NZD, USD was one of them, but there were a lot of pairs that were contingent on where the dollar is going, right? And we spoke a little bit about dollar strength, gold weakness, blah, 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 blah. And you can see, notwithstanding just 3 days into the week, that is Monday, right, Tuesday, Wednesday, right, for the last 3 days, we've cleared that weekly supply, this daily supply here, pushed into the upside, and there we have it. Right now, the whole point is, what did the markets expect when you're doing these interest rate hikes, right? There are 3 things you really need to table out. There's the market expectation, all right, and then there's the reality of what the data means, right? And then there's this. This is big, right? This is Powell literally putting his tail in between his legs and starting to realize that once again, Jerome Powell, was wrong, okay? I was wrong to assume inflation is transitory. It is not transitory. The fact that Powell, and we're going to hear what he's going to say, right? In South Africa, those of you who are not from South Africa, you forgive the example. In South Africa, there was a famous president called Thabo Mbeki, and I read almost everything that he ever wrote as part of my, doesn't matter, some 1980s research I was doing. There was a popular book called Think talk left, walk right. And it actually spoke about the policies and how South Africa, specifically the ANC, fell into the neoliberal capitalistic plots, right? Think left or talk left is to talk like you're all about the people, for the people, by the people. But walk right refers to neoliberalism, monetary tightening, and policies that will actually destroy the same people, right? And Powell might not be able to walk that double lane anymore, right? We'll see what he says tonight. But generally speaking, the markets could. So let's quickly have a look at NASDAQ, right? So I was going to throw in scenario 3 in the public Telegram group earlier on, but then I just got kind of like busy with my kids. Even though we got a very strong 7.5% rate point hike, there is a slight scenario where equities could run positive, could rally positive, right? It's going to be contingent on a couple of things, so bear with me. Number one, what is Powell going to say in the next 25 minutes? Number two, how strong is the DXY supply, where price is right now? Number three, the main reason, and I don't want to confuse you, I wish I had my whiteboard ready, right? I don't want to confuse anyone. I just want you to kind of like quickly throw this out so that when Powell is talking at 8:30 as usual, I'm going to stream it live, but I'm going to have to pause every time I feel like there's something a little bit bigger that I need to explain, to kind of like benefit everyone. But even though we've gotten such a big rug pull, a big interest rate hike, you can only imagine this is also something that the markets have been wanting. Now, the markets don't want this. Don't get me wrong. The markets are not happy about this type of thing. We've been talking about selling NASDAQ nonstop since January this year on the 365 Train Academy channel. We've been following our supplies, and I think we've done an incredible job at sticking to that particular plot. All right. And remember, it matches our January, February analysis. The very first time I showed you guys the governing time frame, I use NASDAQ to communicate to the masses. When I talk NASDAQ, I'm talking SP 500, US 30, Euro USD, Pound USD. I am covering all risk-sensitive assets all at once by referring to NASDAQ, which means the same logic you see here, you apply to all those charts. And I think, for over 2 years now, I've shown you why this is one of the most consistent and simpler ways to trade consistently, at least at a profitable level, right? So this is that channel that we spoke about, and I told you, no matter what happens, we are going to fill it. We are going to complete it. And look where we are now. Now, the reason why I want us to be a little bit, advanced in our approach to today's meeting, all right, is the mere fact that when CPI data dropped last week, or was it on Monday, or was it Friday? Friday last week. Well, when CPI data dropped, those of you in my public Telegram group, you'd already seen me cover this extensively. I'm not going to get into it because of time. But on Friday, we finally got the news that actually inflation was not at all peaked, right? Wasn't cooling down. In fact, it was worse than expected, right? There are many other data points that don't even show up on Forex calendar that came out, in the last 3 or 4 days that have actually completely spooked the market, right? I won't get into all of them right now, but one of the big ones is something called consumer confidence. Consumer confidence in America is at an all-time low. At an all-time low. I mean, talking all the way back to when they actually didn't even have recorded data. So in the 1980s type all-time low. And that is also another thing driving these markets crazy down. Because when consumer confidence is at an all-time low, its simple translation is we're too scared to spend our money. We are not going to spend our money. Whether it's because the price is going up or we think things are bad. A second big indicator, a data flow indicator that if you guys don't connect to the Bloomberg server, won't know about, is the fact that a lot of wholesalers are starting to see a massive increment in purchases. When you start to track such data, it simply means that, remember in COVID, most of you will remember this because you're part of the problem. How many of you overbought tissue during COVID? I don't know who told people that COVID was going to affect their tissue needs, right? But whenever there's panic in the world, right, in a very specific scenario, human beings start to stock up. And when you track how wholesalers are doing, and you start to see this incredible phenomena that actually a lot of stuff is being stocked up. It means a lot of people are anticipating something bad in the market, and if something bad is coming in the market, they are most likely scared, so that they're stocking up for some type of disaster. These small things combined are called self-fulfilled prophecies. I want you to be aware of this. Now, the government's job, if I can pull out my whiteboard here, the government's job in any country, is to, control, crazy events. So remember in COVID, they told everyone, don't panic, just stay inside your house and wash your hands and everything is going to be fine. And millions of people died. I'm not saying it was the government's fault. We can debate that another time. But the point is, any good government, or at least a government trying to be good, its main job is to reduce panic, reduce the sense of fear, right? If you see what's going on in China and the way they are blacking out, the COVID stuff and the few things that come out in the media, China has gone full control crazy. Now, same thing with the markets. The government, and when I say government, I'm referring to the financial part of the government. When I'm talking about the financial part of the government, I'm talking about the Central Reserve Bank. Every single country has a Central Reserve Bank, right? We refer to this as our governor in South Africa, the governor of the Reserve Bank, the governor of blah, blah, blah. Tonight at 8:30 p.m., we're going to be listening to one of the biggest governors in the world. He is the head chair of the FOMC, Jerome Powell, Central Bank. They are part of the government. It is their job to tell you, and this is what they've been telling us, March, April, May, June, don't panic, right? We've heard this many times before, don't panic. We've heard crazy words like transitory, right? Inflation is transitory. What does this mean? It's going to pass by. It's not a big deal. We've heard other words like we are going to get a soft landing. That's what Powell said. When he said this, understand this now, he was talking about roughly a 2% interest rate by the end of the year. So we're going to go 25 basis point, that's a quarter, another 25 basis point, that's 50, blah, blah, blah. And then last time we were here together doing another live stream, he said it's going to be soft-ish. It's not only going to be soft, it's going to be a soft-ish landing. And they were targeting by December anywhere between 2 to 3%. And I've brought this up many times. And I want to do it real quick with you again, so that when the man is talking, you hear what the government wants people to know, but I want you to understand what is going to happen. I have not misled you this far, my brothers and sisters. I am not going to lie to you. Before 8:30 p.m., I also want to talk a little bit about crypto. All right. Now watch this. Inflation, as long as we have known, was up 7%, 7 comma something, 8%, 8 comma something, and now it's rated at a whooping 9%. These are government statistics. In South Africa, they'll tell you that the unemployment rate is 35%. But if you ask a social scientist like myself and you look at the labor statistics, we know that unemployment rate in South Africa is nearing 48 to 49% of the inflation. Governments have a way of, redacting statistics or minimizing them by using fancy clothes. I'm bringing this up because I truly believe real inflation in America is sitting at about 15% and not this 9%. If Powell was to release the interest rate at 0.50 tonight, which we now know he did not, he went with a 75 basis point. But had he done this, stuck to the original stubborn plan of thinking he's going to fix inflation with this silly stuff, the main problem was, when on earth are you going to catch up with inflation? I just posted a picture in the public Telegram group. It was a CNBC guy was basically saying what the markets really need is basically like 100 points, right? I'll just quickly pull it up there or not. I don't know. Maybe my system is overloaded. I don't know. Right. So I just posted this picture right now on the public Telegram, right? Saying, look, we need 100 basis point rate hike, right? That is the medicine to stop inflation. And what these gurus are simply saying is, look, man, we cannot pretend like inflation is going to go away by itself. At 9%, what type of an interest rate by the end of the year at 3% would fix this? If anything, what the Fed needs to do is to rate hike very strong, very hard, very violently. Leroy, won't that crush the stock market? Yes, yes, it will. But as an economist, as an investor, as a retail trader, you need to remember there's something called temporary pain in the markets, and you want that temporary pain. What you don't want is a long-lasting bearish winter, because that not only destroys all your stocks or your crypto, but it kills market morale. All right, and we haven't had such a terrible incident since the 1980s. I wasn't even born back then, right? I've just been studying the works of Ray Dalio to really understand what the hell was going on there. But if Powell and the old fools don't get this number right by the end of the year, and most of us would agree that we need this number not only to meet inflation, but to be above inflation. That is the only way you can tame the beast. You have to kill demand. Now, because Powell and the FOMC have really been very clear about their intention to try and get this thing under control, but also very lackadaisical, very lazy, about the approach to do it. What they have managed to do is create a liquidity crisis. This is what we have right now. Stocks are falling. Right, that's fine. We understand that. But also, housing market is falling. We spoke about this when it was triggered by the Evergrande crisis last year. If you've been on the channel with me for a while, you'd know I've taught you on this. And now crypto markets are falling. The crypto market is the biggest, craziest thing ever, because crypto, by design, by software design, by intentional design, the reason why it even exists from 2009 by Sensei Stokashi, or however you pronounce that Japanese guy, right, is simply to become an inflation hedge, right? That's what crypto is designed for. For times like this, when inflation is going crazy, you have someone stronger, big brother crypto, who can not only wrestle with inflation, but you can hide your money inside cryptocurrencies during that time. And we now know that that thesis right now is failing tremendously. So we have a all-time liquidity crisis. Right, there's nothing to hide your money. Bonds are falling. You can check for yourselves. And so markets are very stressed. Now, why, Leroy, do you think there is a possibility? It's not even a high possibility, but if it does happen tonight, Friday, and then really from next week, I want you to understand why. Why do I think there'll be a temporary bull run? Right, there might be a temporary bull run to reward Powell for having the balls to go 0.75 basis point, because this is what the market have been pricing in, right? I spoke about this a little bit in the public Telegram group, that a lot of people now are saying, look, man, we need more interest rate hikes, because the market's bigger than the current problem of stocks falling, crypto falling. The markets want to end the problem at its roots, right? So if Powell and his boys come out and go 0.75, which they've just done right now, it might indicate to the market that we finally have leadership that is done, messing around, tiptoeing around the problem, and might actually start to take bold, courageous action. Now, if you follow me again on the channel, you know that since January I've been saying Powell is behind, and it is very difficult for these guys to catch up. I don't want to lie to you. It is absolutely difficult for them to catch up. But if there is a bull run, it's going to be temporary, and this is the reason why. It might be because the markets feel like finally, at least they are now starting to face the real problem head on. Right, so now let's quickly switch to some chart work. Let's quickly look at what we have. So in the public Telegram group again today, I keep bringing that up because if you're not in our public Telegram group, then just check the links in the description and join, because I do a lot of teaching there, right? I give signals on Sundays during the week. I teach, educate, answer questions. We don't sell our signals. What's the point if you don't understand what we do and why we do what we do? Right, so let's look at Bitcoin, number one, because I feel like This is a perfect chart to kind of like consider. We need to consider a lot of optics. The first thing I want you to know, and my goodness gracious, unfortunately, the chart that I marked up for the public Telegram group in the morning, I removed it simply because it's not how I like my charts, but I can quickly find it for you because there's just something in there that I need you guys to see. There's just something so important that I need you to understand. When we talk Bitcoin, and let's quickly pull it up here. There we go. Right, so this is what I did for everyone in the public Telegram group, right, this morning about Bitcoin. I showed you guys that since 2009, right, Bitcoin is new, crypto is new. When I say Bitcoin, I'm referring to the entire crypto markets because we know it was started by Bitcoin, and Bitcoin is until it loses all ground on the dominance chart, Bitcoin will always be the go-to for risk sentiment in the crypto markets, right? And then with an interesting problem from last year into this year, where crypto was now coupled with the stock market. So these things were moving in line, not in opposite, not as an inflation hit, right? They were literally moving in line. Now, we've had two real fundamental market crashes in the crypto market, right? I know there are many times where price goes down and everyone thinks it's a crypto winter. No. I'm talking about a real full-blown crypto winter, right? And this is really between December of 2013 to January 2015, where crypto fell 87%. 87%. That's no joke. I did not even want to complicate my narrative in the morning because I was in a rush, but I can teach on this another time about the different stages, right, markets move in, and the fact that this crypto winter is normally met with accumulation, which triggers or ushers us into a period of Bitcoin halving, right? There's something called Bitcoin halving in 4-year cycles. I haven't taught that on the channel, but I will at some point, right? And then another winter comes, and then another accumulation period comes just before. And I think the next Bitcoin halving period, by the way, is 2024. And here you can see you can have a 2-year bear market in crypto. It's not difficult. It literally can happen. The next big one was the popular one. I say popular because by then Bitcoin was known, crypto was known, everybody thought it was a scam. Everybody had their own opinion, their own uneducated opinion on the matter. And again, from its all-time high, right? We're talking about crashes from all-time highs. From its all-time high until it found a bottom, right? It fell 85%. This was between December of 2017 to December of 2018. So 1 year, the whales were taking profits, right? And some crashes are not even crashes, but markets are different, and we'll get into that another time. Powell is about to speak in 8 minutes, so I'm in a big rush here, but I'm going somewhere. I've done a lot of work on this thing, and I've already put out a lot of predictions. A lot of people have called me crazy. Now, some guy was trying to sell USD CAD today. I told him don't do that. He's been stopped out. He called me crazy. I got a screenshot of that. And I'm telling you now, people said we're crazy for 30K, 33K, 28,500K, then 20K, 19K was the next call. And if 19K breaks, which I think it will, I truly believe it will. It's a weekly demand. I'm going to get into that right now, right? But you can see here, I've priced in Bitcoin coming in at about 12,000. There's this weird range, if you in the public Telegram group, I wrote the exact, levels, like something like 11,000 or something. This guy was drunk, well, not actually drunk, but I'm saying what he's saying does not make sense. I just laughed at this thing and moved on, right? Right. So now let's look at the charts. All of that stuff that I just showed you about Bitcoin happened when the economy was going through a steady time period, just come out of the dot-com crash, 2000 crash, and literally starting to pick up from the 2007, 2008 market crash. I want you to really understand what that means. I am saying to you, the two big crypto crashes in the world, right? So the two very big ones, 2013 to 2015, and then again 2017 to 2018, happened under economic environments where markets were still pushing forward, where the market, the actual global market, was going up and up and up, right? And then you had crypto trying to find its feet, so it would crash. So let's call this 2013, the first big one, right? And then it would find some type of recovery and catch up with the market, the global market. So there was no recession, there was no stagnation, there was no stagflation, there also was an inflation. In fact, we had the craziest bull market run. If you focus on 2010 right into 2020, we had two beautiful decades where all you had to do was to have a unit trust and you put $100 or $200 and you hold in the S&P 500, getting 8% a year. You would have been a millionaire, right? The Bill Gates, no, not Bill Gates, sorry, the Warren Buffett simple methodology. And then again, another crypto winter came. Let's call this one 2017 to 2018, right? And again, there was another crypto crash, right? You see there, Bitcoin crash, right? But what was going on? Markets were still doing okay, right? So as markets are doing okay, right, investors have a place to move money. So you take it out of the risky assets and you dump into another. That's what we do here. We have to constantly think, what would rich people do? How do billionaires move? And that's how you adjust your portfolio. Now, here's the problem. Comes COVID. Now, COVID is unfortunately, we're not going to get into conspiracy theories, right? We don't know what, who, where, what. We don't care anymore, all right? As long as they're not putting, never mind. But the point is, COVID happens, all right? And we notice that these things meet here and couple up. So everything crashes. When COVID came, oil dropped to negative numbers. I told you, buy oil, 0.01, add oil for $1 and hold it for the rest of your life, right? Oil was at an all-time high right now at 120, going to 150, going to 180. You could have made a lot of money with little money in 2020 if you just bought it on any broker and just held when it was at negative numbers. You could have over-leveraged because there's nothing to lose. I will never forget this. There was a point where all brokers were not allowing people to sell stocks, to sell Nasdaq, and to sell oil, and they were only wanting buys. That's like, look, man, we will give you free money. Just stop trying to push price down. Retail traders, help us buy. Just buy this thing. That's where we were. And immediately in 2020, Federal Reserve, Powell, the guy who's trying to fix the mess, started to print a lot of money here in 2020 of March. They opened the tap, quantitative easing, and then crypto markets also went up. Bitcoin crashed here to about $4,000 in 2020 and went to an incredible all-time high of 65K. Now, here's the problem, ladies and gentlemen. The problem is this current crypto crash is new. I don't even have the type of data I need to make a very comfortable. I know what I'm doing. I know my projects. I'm dollar cost averaging. I'm not shaking. But I want to ask you this. In a recession, what happens in a recession is the first thing is people lose jobs. Your company isn't going to keep you unless you're essential, because companies, when it comes to capitalism, a human life is worth the same amount as dog poo. You understand me? In capitalism, I want you to know workers make money for companies, but companies do not value workers. They will fire people. We're talking about millions of layoffs. So unemployment numbers are going to become very important very soon, because we're going to see those going up. Coinbase is already retrenching 18,000 or 1,800, I've forgotten the number, of its workers. Coinbase. But dude, you guys are literally holding a lot of people's money, and they are worried about an extended crypto winter. And the reason for that is this economic trend line, this economic upward climax is broken because we got a crypto winter during a liquidity crisis. Problem number one, I've explained what that is. Problem number two, we have a crypto winter in the middle of the beginning of a very dangerous recession. I've been saying this for a while, lost decades. Problem number three, we have a crypto winter in the midst of inflation. It's wild. So the money that would pick up crypto every time it crashed would come from profits being held in other assets. In a liquidity crisis, ain't nobody got money for that, because what Powell is doing is trying to fix this stuff, right? Increasing interest rates by breaking the demands. I've taught on this a couple of times. So who's going to save the markets? Number one. Number two, you think if you start to lose your job and you have no means to eat and there's no income and your kids still need to go to school, so you still need to pay school fees, you still need to buy expensive fuel, expensive cooking oil, what's going to happen to people who have been taught the whole philosophy? How long is life going to tempt you and push you to the edge to a point where you can't hold anymore, right? These are the things that we kind of like need to consider. I have to shut up now, folks. I think Powell is about to talk. We just need to hear. That's why we're here, right? So I'm just going to keep this. Let me refresh this. I'm just going to keep this tab open here just in case it started. And if it has started, I'll keep quiet, right? But I hope you guys understand the type of climate we're in, right? We are in interesting territory. It's 8:30. I have terrible weather, terrible weather, terrible internet connection. I'm starting to feel like I'm not even online right now. All right, so we wait. Oh no, it started. You guys hear Powell?
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture
Powell clear, guys. Can you hear him?
The labor market is extremely tight and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance.
Sorry, I know it's live for them, but for us, we're going to take it nice and slow. I do need to know if you guys can hear Powell, because I have to switch audios to kind of like play that. All right, fantastic. Thank you. Right, so just keep this in mind. He's just said, look, we had to do 0.75, and he's just said right now, we think we will continue down this path, right? So the next one, he's telling the markets that we're going to go 0.75. This is important because what you're going to be trading for the next month is markets pricing in this thing. So when I say sell for the next 2 months, this is why markets have to price in this thing, that interest rates not only went up 0.75, but they're going to continue. So we're going to be behind a little bit with the live stream. I'm going to pause a bit for that type of clarity, right? Just to explain stuff, especially for those of you who are new. Don't forget to like the video, guys. Thank you.
I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. Spending and financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. The past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%.
Sorry, guys, that's important because that's NFP, right? He's just said the unemployment rate, they foresee it going a little bit higher than what they reported last time in March. Last time in March, Powell was very proud of the employment numbers. They were keeping unemployment rate at about 3.5%. Now he's saying we expect to see this number go up a little bit to 4% by some time next year, which means people are going to start losing jobs. I don't know why they just don't talk simple like that and just say we expect to see more people lose their jobs, but that's what that means.
Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the consumer price index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. Surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and it's creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Taking appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Right, guys. So the questions are about to happen. We're going to let them go ahead a little bit without us. I just want to make sure I explain a couple of things to you, because remember, the questions are going to be important. The people asking these questions are not stupid. They know what they're doing. Most of them are people we read reports from on Forex Live, CNBC, etc., etc. And they're going to be trying to understand Powell's logic. And I just want to bring up a couple of things I was writing down in the background. I trust you guys can hear me, right? I did put up something there that I had to switch mics real quick to get to Powell. So please, just one person just say yes if you can hear me loud and clear, so I don't have to redo the sound system. Right, so this is what Powell said. He said GDP is doing better. Lies. All right, lies. I promise you, I'll do a full-fledged video next week and I'll show you. Right, so how do we know you're in a recession? So the common known way to calculate a recession is all you need is two negative financial quarters, right? Remember, banks think in 3 months, take profit in 1 year in a 10-year plan. You need two negative financial quarters. Q1 was negative, right? And that the graphs and all those things that he's referring to is from a document called Summary of Economic Projections. I did it with you guys in the March one, economic projections. I'll do a follow-up video with the new one, right? So I'll look at that document that he's talking about and I'll break stuff down. When you get two negative quarters, so quarter one, January, February, March, quarter two, April, May, June. When you get two quarters and both quarters come out negative, you are in a full-blown official recession. That is where we are going. And I guarantee you, once again, the government's job is to tell you what you need to hear to continue not to create a self-fulfilled prophecy. If the government tells you recession is here and you're all screwed, everybody's going to stop spending. Everybody's going to keep their money outside of the bank. Everybody is going to know not to continue. And that creates a terrible domino effect on the economy. So it becomes a self-fulfilled prophecy. You basically create recession by telling the masses there is recession. You rob the masses of preparing for a recession, but you actually buy yourself some time. Right, so I want you to know this lie was a big lie, big bad lie. Then he said consumer bias, sorry, I wrote basis here. Bias is doing well. That's also a lie. I just told you that consumer bias literally fell to the lowest since 1980. All right. And I showed I to double check that data. I also looked at wholesalers, and they have just received a 10% boost across most market ranges, meaning there is that type of fear, the COVID buy tissue in bulk fear, buy baked beans in cans for the next 10 years type of fear. And then he said, okay, I'll do this for you guys. This document here, we need to break it down. I'll do a video on that. And then he said another very important thing that they're about to question him about. He said ongoing rates will be like this, and he believes they'll have to be appropriate over the coming months. This is not someone telling you now that inflation has peaked. He's saying we might actually need to continue increasing the interest rates over the next coming months. And then he said, yeah, later on he said, yeah, but 0.75 is unusual, right? And then also he said, look, man, in our next meeting, we are going to go either 0.5 to 0.75. This is the problem. This here is what is called market uncertainty. Markets don't know what to price in. You see, if Powell was to come through and say, look, guys, I'm just going to do a market rug pull. I'm going to go 1 full basis point for the next 2 meetings so we can catch up. That would be great. All right. It just takes time. Right. So I want you to understand this, because now the next part of this, the conference that we're about to watch is the questions. And they're going to be asking similar questions, I'm sure. I don't know. Right. But I want you to have this type of understanding to hear his answers. Right. Uncle EG says, very good analysis. Leroy, just wish more could watch and understand economics. Blessings, Uncle EG. Good to see you, man. Good to have you. Right. So let's quickly check out the questions and then we'll call it a night.
Thank you. Howard Schneider with Reuters. 2 related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
Okay, so the question here is quite simple. Why did you lie? Do you think you lied last time? Last time you said it's under control. You're going to only do 50 basis point in June, 50 basis point in July. And here you are now, all of a sudden on Monday, this 2 days ago, clearly in America, you might have hinted that you're going to go 0.75. That's basically the question.
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Thanks for taking our question. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Right.
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels. And we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range. And that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And, so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seemed like the right thing to do at this meeting, and that's what we did.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate. That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, But ultimately, it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see.
So I'm trying not to pause too often, but do you hear that? We would like to see demand moderating. Demand is very hot in the economy. So again, when Powell looks at your buys, and I'm talking to traders, so it's not really the case here, but he's really talking to investors, billionaires, millionaires who put their money in the stock market, for example, and he looks at the Nasdaq, right, the total composite of tech companies. He's saying, listen, man, the buying power in this asset needs to be moderated. It's still hot, needs to be reduced, right? In fact, if you're to have an honest conversation with Powell, I'm guessing, I'm pretty sure he would tell you, right, like that, look, he would prefer the markets to go back to the levels that they were at pre-COVID. So that's why my Nasdaq chart is marked out like this, right? We're looking at that first strong demand wave that broke markets out of that March of 2024. And I've told you that, when price was still up there, that this thing is going to come, definitely all the way down here. And if down here doesn't hold, this demand is at play. This demand is at play, right? And since I've already paused, just something real quick about what Powell is saying, the interest rate, the recession, blah, blah, blah. He's tiptoeing around things. He keeps talking about, futuristic data. In the public Telegram group this morning, we spoke about MicroStrategy and how they were not going to get margin called because they pretty much bought more. They borrowed more money for collateral, blah, blah, blah. But, Michael Saylor said something dangerously interesting in that short quotation mark that I posted in the public Telegram group. He said, even if Bitcoin comes down as low as 3,000 and something, we will find something else as collateral, meaning we will buy more Bitcoin. This is someone who's currently holding over 130,000 Bitcoin coins, which is over $400 million US in loan to buy them. And he is thinking that there is a possibility of price even breaking Leroy's, lowest point of 12,000 US, right? And now I'm saying this to say the FOMC just said the demand in the market is hot. We need to moderate it. The man just said that out loud. The biggest pro-Bitcoin institutional person I've seen is Michael Saylor. And today I posted on the public Telegram group, he said, even if crypto, Bitcoin specifically, comes down at 3,000, I'm going to keep borrowing more money and keep buying this thing down there. Right. So what are these guys saying, man? I'm telling you now that there will be a bounce at 19,000, 20,000 here on Bitcoin. But this is not the bounce that will take us to the moon, in my humble opinion. I feel like we still need to come down a little bit. The question is, how far down is cool enough for this man in front of us here?
Getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So
you guys hearing this? The problem in the market is demand, more buy power, right? We need to kill this. We need to slow it down.
Feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But this 3.8%, 4% get it done because it gets the job done and breaking the macro inflation.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there. Really, honestly, that would be, you would have positive real rates. I think, and inflation coming down by then, I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're gonna find that out empirically. We're not going to be completely model driven about this. We're gonna be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely...
Sorry, guys. Remember when we started this video, I said the scenario 3, don't get confused. If it goes 0.75, right, which it did, markets might take this positively, which they are, because he's saying right now, this is something we're trying to take seriously. And markets are saying, finally, yes, interest rate hikes might create short-term pain, might damage demand, but at least we now have some type of leadership that is aware of the problem. Now, as a supply and demand trader, by the way, a lot of people have different trading strategies, but you will never hear Powell refer to support like someone today wrote supply and demand is the same as support and resistance. I don't know. But now have a look at the chart on the daily time frame. What is Nasdaq 100 trying to do? All right. And that's really what your trading mindset needs to be. Here is a popular place for retail traders to try and sell. This proximal line on the smaller time frames will act as a resistance, right? I want you to think beyond that. You're going to start to calculate how far a relief run can go, all right? Whether you pull out a Fibonacci from this previous supply that broke structure, etc., etc. So that if I start mapping up trade ideas, we'll be here all night. So we'll do that tomorrow together. Tonight was just to get what the FOMC is doing. But this is literally how we started tonight's video, was the fact that even if we get a rug pull, a high interest rate, markets might take that as temporary positive news that at least Powell might be starting to wake up to reality. All right, and you can see for yourself, there it is, Nasdaq by the hour, right? Extremely bullish. And I say the second factor that's going to contribute to that before all of this happened was how strong that daily supply, which is a nested monthly supply, right, in the DXY was going to act. And you can see markets made contact with my white lines on that daily supply that we spoke about during the war room, and today prices dropping. None of these moves are permanent. This is, markets simply reacting to data, right? I promise you, the real trends will start next week. Trust me on this. As usual, Monday, Tuesday, you're going to see markets start to pick up and start to price in what they believe Powell is saying, right? Let's let markets digest the news.
Absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI rating.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
I'll just say we're going to react to the incoming data and appropriately. I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're I think as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking. Ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done. Because we saw, frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible, sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
And I think that I do think that our objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things. So, having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down.
You guys hear it? This is like the third time he's saying this, Nick. Move demand down. Like he's very clear.
Surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4. The median is 4.1%. There, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%. That's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
People losing their jobs, or
we don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic. where participation is high, where there's lots of job opportunities, where it's just a really, I mean, the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that. And it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell, Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple of years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means that FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for, such reduced confidence against, say, a month ago or 3 months ago that
come on, man,
will largely
that's been asked already
as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
Yeah.
So we're, of course, watching very, very carefully for that. And, looking at the retail sales, the big store numbers and all that kind of thing. And so but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall spending is very strong. The consumer is in really good shape financially. their spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels at healthy growth levels.
So then, as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit, we're responsible for watching everything. But consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect really. I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Can I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Yeah, so many questions today, man.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings. in real time. So that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe I'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like, you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down.
Sorry, it was transitory.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. Particularly, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Hope you guys are doing well. Welcome to my.
Hi, Chair Powell, Nancy Marshall-Genser with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. I would call that as meeting that test. Do I still think that we can do that? I do. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised a degree of difficulty, created great challenges. And again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
People.
Thank you. Greg Rapp from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rate.
Sorry, guys. Looks like there's just about 2 minutes left, so might as well just finish it. It's about 2 minutes left next.
So could you talk a bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the twos probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, and we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
Of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks. If you think about it, the pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces to what extent are they going to be sustained. In other words, will we go back to a world where it looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will.
Right, ladies and gentlemen, this is the best I can do for tonight, man. I am absolutely frozen. The questions are so repetitive that they feel like they're asking different things. But the thing is, Powell's script is the same, right? The answers are still the same. So if you can just do me a big favor and we leave it here tonight, I will read the summary of economic projections document that came out with this press conference around 4 a.m. when I wake up tomorrow. And then if I feel like I need to do a whole video breaking down these numbers and these figures, I'll do that for you guys. But thank you so much for watching. If you're still with me, shake my hand. We didn't start the video that way, but we're going to end it that way with a good handshake. And then, stick around. Tomorrow, I'll be putting out another video. I owe you guys a video around COT data. We're going to see if the COT data confirms all of this. I have marked out some slight movement on the charts, Bitcoin to the upside. And this will be based on how strong, the risk appetite is in the markets right now. Can NASDAQ make it all the way to about, 12,300, 12,200 levels? And what's going to happen there is a deciding factor. And this is all being pulled by, money rotating away from the dollar. So you can see dollar made contact with that supply. This would have been the only trade I took right now, and it's not because I took the trade during the live event, right? It's because we spoke about this, supply in the war room, and I put a pending order. And so all I do is I just wait and I get triggered. But it's not a long-term sell signal for me personally. We'll see how this area holds. All right, so I can see this little H4 demand here has been used once, and then there's a weird demand here that's just been completely liquidated right now. So if this area breaks, 104 breaks for DXY, that's the only reason why I want to be in this sell, because if this area breaks, then we're in for a very good long run, right? So this would be very nice to take profit somewhere here. And then, imagine continuing the downward path that this downtrend stopped at. Because remember, the next time I really want to buy the DXY is all the way down there on the daily time frame, right? So we've got some good movement and good direction. It's just all about how do markets feel, right? Very important to note why I'm not that committed to selling the dollar right now is we don't have a bearish engulfing pattern. It may look like it from a mile away, but it is not. It is not a bearish engulfing pattern. This, to me, is a sure sign that the selling here at this level is not that convincing, right? We'll see how far it goes, but we do not have a bearish engulfing pattern. You see this little circle here? We did not have a bearish engulfing pattern here on the daily. So price didn't even stop. Price didn't even consider to look to the left. And I'm telling you now, right, that this is, something very similar, right? And the weekly supply here was broken a long time ago, right? So I'm not selling right now because I think dollar weakness is about to take over. In fact, the opposite is true. We just got a big interest rate hike. Generally speaking, that's supposed to be good for the currency, but the currency will first fall to get a good deal, buy low, sell high, right? And so that's what is going on in the markets right now. The reverse is true. Dollar is moving down to find the next low buys. Indices, crypto are slowly starting to find their way back up to find the best sell positions. All right, 365, shake my hand. Thank you so much for chilling with me on a cold Wednesday evening. Definitely hoping to make time to do something special for you guys on the channel. We'll do something on Friday, and then I'll see you guys on Sunday for the war room. Right, I'm out, everybody. Have a good night. Thank you all. Peace. I'm out.